From safety to liquidity, a different kind of risk, but just as crucial. Our next session unpacks what it really takes to stay competitive in today's liquidity landscape, from access to aggregation, and yes, chasing alpha. Moderating this session is Andrea Badiola Mateos, co-CEO of Finance Madness. She's back, and she's ready to get into the details. Please welcome her and her panelists once again on the stage.
Thank you, Despina. Welcome, everyone. Thank you so much for joining us for this session. Liquidity, it's always one of our main topics in every expo that has to do with institutional activity and professional, since we're in the world of fintech. I'm joined by an amazing set of panelists. Many of you have already seen some of the guys here, some of the new faces as well, so I'm going to ask them to introduce themselves one by one. We can start from my left, John.
Good afternoon, everyone. Hello from Cyprus.
Hello.
John, excuse me. The mic is unusual.
It's on.
I'm a Chief Dealing Officer at Beats Broker Group of Companies. We are a provider of technology and liquidity services.
Thank you, John. Andreas?
I also work in the same space with my fellow friend John. My name is Andreas Kapsos. I'm the CEO of Match Prime. We operate obviously on the B2B side. Thank you for inviting us and for the opportunity as always. Happy to be sharing the panel with John, Liam, and Reggie. Looking forward to discuss. Hopefully, if we have anything that we can discuss with you, it will be great.
Perfect. Thank you, Andreas. Liam?
My name is Liam Smith. I'm the Chief Operating Officer for Europe for 26 Degrees. I will stress the Europe part because our global CEO is in the audience and I don't want to upset my boss.
Not want to step on anybody's toes.
26 Degrees is one of the original Prime of Primes, and we've been providing liquidity to many people in this room for over a decade, and I've been the pleasure of being part of the team for 8 years.
Thank you.
Hi, everyone. My name is Reginald Cherikete. I represent the group. My experience in the market is predominantly risk management, where I act as head of risk from a global risk management perspective. Today as well, I'm recently fronting Do Clearing Global, which is our newly established institutional business line. And I'm glad to also join all of you guys and the panelists to discuss this topic today.
Thank you all for joining us. So we're going to have a discussion between the panelists and myself for the next few minutes. And then before the clock takes 5 minutes, I hope, it depends on your answers, we'll try to open the floor for questions so you guys can start taking notes and keeping them for the end, questions at the end. I want to start by talking a little bit about what does liquidity mean in 2025, because obviously, like I said, we talk liquidity in every single event that we have because it's such a crucial part of this business. But what does it mean in 2025? Is it a part of the business that is becoming more concentrated, more democratized? Who wants to take it? Andreas, I see you're very excited. I know you want to jump at it.
I'll start. It's not that you put the date there, the 2025, because it's very different this year, I would say. You know, if you ask me this question a couple of years ago, I would say concentrate on reliability, but now I would add business continuity. It's so important now for businesses and brokers, business continuity, to be spot on with their liquidity. Now, to answer the question whether I would see it as more democratized, I would say definitely yes, because you have the brokers are in the great condition and position to be able to choose from several liquidity providers which are doing a tremendous good job, and I think that helps the business in general and also ourselves as well, because we learn from each other, and I would strongly believe that it becomes more accessible as well for brokers. So if they do their homework, let's say, the right way, they will definitely get benefited from it.
Mm-hmm.
And I totally agree. The homework, I think, is the key thing, because there's so much access to feeds and dozens, right? And it's sifting through, disparity in quality, I think, and sifting through the ones that are giving you what they're promised and what you need. And we really try to help our clients sort through the data, in 2025, massive amounts of data, and filtering through it for the right insights, I think, is the tough part. So yes, it's democratized, but I think there's still some concentration on the quality feeds.
Mm-hmm. John?
Well, clearly, I think that over the years, people have become more and more sophisticated. So the type of research they conduct on our line of business has changed for the better of all of us. I think that now the LPs have to be very agnostic to what the client needs are. It's a time in where things are changing very fast. So tech is a very important part of that component that the LP utilizes, whether it's a fast price or not, is what's going to make a difference in that client experience. I also believe that something very unique has come into place is that there's a lot of new participants coming in, which obviously brings back the topic, the race to the bottom. Are we really heading in that direction and for how much longer? And is it sustainable? If profit margins don't really match the type of investment you're conducting into your business, then it starts to become a bit of an issue, because if there's no profitability, that capital, then we all start to face new challenges. So I think today, what really goes on in the space is that you got to compete for that business like never before. And that in itself is a tremendous challenge. But again, it's always good to be on top of our toes. I think that's what keeps us all going and reaching new heights and providing better services to the industry.
All the variables that we mentioned now, I mean, the ones that we mentioned, technology and all of that, I don't think there is room to be behind on any of it now. You have to keep up with all of them, all of the components, so that you can be able to deliver what the actual broker needs right now. And actually, it's good that we have Reggie here, because he's on the other side, and he will concur or tell us more about that.
Definitely, yeah. From my end, I think to a huge extent, looking at the last couple of years, decentralized finance with blockchain has allowed more retail players to get access direct liquidity, as compared to traditionally that we needed to go through an LP. So to a huge extent, a retail trader now can just trade tokenized synthetic FX, crypto assets or commodities directly through an exchange. But we still see a huge dominance though on the institutional side, where you still have concentration in terms of the more established prime of primes, as well as on the traditional asset classes, where you still have those guys who have bigger muscle. They still dominate the market. And from a retail perspective, broker to step into that kind of level or to level up to that is quite difficult in terms of being able to enter there or operate in that space. But to a huge extent, I believe with decentralized exchanges, retail clients can get access, but still on the traditional asset classes, we still see concentration from the big private primes and banks and all.
There is something very interesting that I want to pick up on that, Andrea, as you mentioned when you started, and I'm going to tease you all on this. So you mentioned that there is a high extent of almost collaboration between all of you, like you all talk, right? I think after these many years, there is something very particular about the liquidity space in this industry. So I'm in touch with all of the different actors at all different levels in this industry. And I don't think I have seen such a close level of cooperation between direct competitors more than I see in the liquidity space. So like you were saying, right, like, I mean, you guys are talking all to each other and like you're saying, the race to the bottom, right? So I think that talking together is also allowing the space to remain stable and to not be extremely disruptive and more inclusive and collaborative rather than confrontational. Am I wrong?
No, definitely not. Okay, so I haven't had the opportunity to obviously collaborate with the gentleman sitting on my right and my left, but we discussed it many times, you know, and there's no doubt that we do that, you know, because now we've reached a point where the collaboration and the I'll scratch your back, you'll scratch mine, let's say, direction is good for everyone. So yes, we do share information. We might even collaborate. So I hardly use the word competition. At least that's my side. That's not how I see it. And at the end of the day, what's the aim? The aim is to accommodate the B2C, our end client. So the best way to do it, if you cannot accommodate or you cannot provide exactly what he wants, you want to help him find it. And that's what we do. Especially now, I can give the example. I'll bring it because I'm sure we have to get the elephant outside of the room. The gold. Everyone's packed with gold. So what do we want to do? we want to say no to our clients. No, we will collaborate between us, see where there is room for us to collaborate. We will discuss and manage it the way we both want.
And with the availability of the access, it's so easy for people to aggregate and anyone to plug in multiple feeds is sort of forced to, right? Not that I don't want to chat with these guys, but forced to collaborate. And at 26, we're really focused on letting the data talk for itself. So it's a level playing field, and the price on screen and the execution, so who can do best and win the most flow. But collaboration is very important.
Yeah,
So
sorry. Because most of the time the client trusts you, so they will ask for your opinion as well. So you will have to give them the solution. Yeah.
It's a relationship matter as well, right? Because it's always institutional, B2B, relies on relationship.
I think it's easy to forget the importance of relationship with the access and technology, but I think at the end of the day, this is still a relationship business.
Yeah.
I'll just add on as well to say from a retail broker seeking liquidity, I think flexibility has been the biggest challenge. For example, now with concentration limits in, for example, gold, NOP limits, it's quite difficult to find a liquidity provider that sort of can understand what are your business needs. And what we've seen with most of the LPs that we've spoken to is they tend to offer flexibility in different ways, but what happens is there is sort of obscure commercials in terms of most of that flexibility then tends to be priced in, whereby you don't actually understand how the pricing mechanism then gets derived. And that cost of transacting with LP, maybe some might get kickbacks in terms of rebates or revenue share agreements. But then in some instances, if you're smaller, you then don't have the power to negotiate this kind of commercials with the bigger PBs and LPs.
Very, very good points. I actually have it written down on the notes. Do you guys think that brokers nowadays understand the pricing and the value chain of liquidity, or like Reginald is pointing out, in some cases it's obscure? How clear is it?
I think it should be clear, right? Like technology has given brokers and firms access to the data and to that look through. And especially like industry leaders like 1.0 and like Match Prime, B2 Broker, I think the tools that now firms have at their fingertips is better than ever. So I'd say to firms, if they don't have the transparency or the data that they want, then they should speak to their providers, because it's probably there and it's probably just a case of learning how to use it better.
Is it a matter of leverage, like Reginald is pointing out?
That's always going to be a problem in like capital markets, right? No matter what industry you shift in, the bigger you are, the more leverage you have. But I think back to the original question of the access, there are more providers, and unfortunately the race to bottom, there probably is someone that's willing to give you a better fee, but you also don't want to be jumping around constantly, right? So it is a tough position.
Yeah, it is. I think maybe to just add on, from where I come from, I would expect that the pricing should be uniform. The cost of buying one apple should be the same of the average of buying 5 apples. If it's $1 per apple, then if I buy 5 apples, I need to pay $5. But then what you tend to see is from most of the liquidity providers, they tend to give discounts to people who can send huge volumes. But then if you're a small broker trying to get liquidity, and at that starting point you cannot meet the certain volume thresholds for you to get discounts on the fees, it sort of like stifles your access to liquidity as well. So I don't know if there is any innovation from the more established liquidity providers in that space to sort of unify the pricing metrics.
It stands, but as Liam said, it's inevitable because it's in all the industries as well, so it's always the case. You can leverage yourself obviously better when you have big volumes, that's the truth. I see that though even on small startups, because we deal with startups as well through their technology. Usually they will go with the white label, and so we see the growth at the beginning is what also Andrea said. They get to start with not having the full picture. So slowly they get to know, but the education is faster now from the startups until becoming like an actual broker. The timeline is faster than it used to be. So they get educated, so the expectations are higher, faster now.
Is there a need for education on this part of the industry? Do you believe that it can help the industry grow faster and further?
Education, of course, but again, as I said, it's expected. They should know that. They should, since they're penetrating the business, they should already know that. And sometimes you don't see that, especially in startups. It's very obvious. We see it. They need their time.
I have to ask John because he's been very quiet. That worries me.
It's not a bad thing. What I do have to say is, especially guys like myself, now doing this for 25 years, I agree with your statement. From the time someone goes to market until they start to grow their business significantly, it's a lot quicker. I also firmly believe there's a lot of more knowledge out there today because of the internet and many other tools that are at people's disposal. I remember 25 years ago, it was a very different world. Information was not always available to many. I think going back into the previous question, I wanted to add on, people do tend to have a lot more knowledge these days because there's been a lot of companies out there who have done a great job sharing knowledge with the industry, and the industry itself has become a much better place today than it's ever been before. I can go back 20, as I said, many years ago, where things were slightly different. I'm not that young either. But anyhow, what I do see is a lot more maturity, and that's great because we're creating a better industry for all of us. Yep. The more knowledge people have, the more you got to compete for that business, but essentially you have a healthier, longer term relationship with your clients.
And communication got better.
Absolutely.
So we communicate. We understand that they understand what we're telling them, where back in the days it was all about numbers,
Yeah, and I guess that now as well, because there is specific hubs in the world that have become, before it was obviously London and New York, but there is growing hubs for fintech that have been set up in the world, including Cyprus, where we are right now, Dubai, so on and so forth. So all of you guys and all of us, everybody in this industry is kind of gathering around them. So that facilitates as well this direct communication and the building the rapport, what you were saying, Liam, about the relationship that sometimes is underestimated, because whenever it's B2B, you need to see the person behind the business, and at the end of the day, who you're trusting is the person, right? That they're going to be there for you if your business is in trouble or needs something, or you need something fast, right? Or you're going to trust them that they're being transparent with your pricing, right?
And that trust is important because you can jump around very easily, right? The systems let you click a button and your whole business is shifted. I think it's unlike any other industry, really, to be honest, of how quickly you can win and lose business. And you need that trust because no one wants to be jumping around. And also flow profiles change, liquidity changes. So you need the trust to be able to see through the peaks and troughs, not jumping.
Reginald was asking you guys directly, actually, a question which I actually had also on the list, which is, about the innovations you were saying. So what is currently the space in aggregation and innovation within the space of liquidity for brokers? Is there anything new that brokers should know about? Is there anything is there a request that you have from them as well?
No, look,
this is where the future gets done. So
definitely, I think from a CFD broker who is seeking liquidity, most of the time is you tend to use third-party systems from a different trading platform that you need to integrate with a different vendor for a bridge. And I believe maybe the more established brokers or players, they are vertically integrated. They are doing liquidity sourcing. They're probably on the technology stack. So they have an edge in terms of detecting how the development of aggregation engines on their end. While if you're using a third-party vendor, usually that control in terms of how fast the product develops is much slower because they are saving a wider clientele base, and it might not be in their immediate plans. So we tend to, when we're choosing LPs, to sort of go for those who are mostly vertically integrated because they are able, or their product is much more adaptable and is changing faster. For instance, like a Do Group, one of the things that we're looking for liquidity is a liquidity provider that has more AI-driven features on the aggregation engines, where you can sort of predict execution. I think traditionally, it used to be about speed of execution. I think now it's more about predictive execution, how intelligent your aggregation engine is able to assist you in that part. So this is, I think, where I'm seeing maybe there is need for the traditional bridge providers where they need to step up. But more established brokers, I guess they're way ahead because they sort of control the development aspect of the aggregation engines.
Yeah, like smart execution. That's sort of to your question, what's new? I think the industry has actually shifted quite dramatically in the last 9 months, and not so much on the pricing side, but on the execution side. And I think it is because of AI, and like we've invested heavily in that space. And AI is such a buzzword, right? The machine learning, and I think in our space, people have been doing the sort of statistical, historical assessments or like models, running those for quite a while. But the AI brings in that ability to do it much quicker and far more rapid than it ever has been able to do before. And Reggie, to your point, integrating that into systems is really good, and that's something that we have done, where you can now, like trade by trade, assess the characteristics of that trade and make decisions and adapt quickly. So yeah, I think it's been a big shift, and I think it's all on the execution side, the focus at the moment, because anyone can show a price on screen, but it's where you actually get filled.
And this vertical connection that Reggie said, we also adapted with our system, and that brings progression and an improvement, because what Reggie will demand from our systems, they will be adjusted, improved, and then offered to the rest of our clients. So having that feedback from here, and here, it comes all together, and it has a direct impact on the product.
Right. That's why we have these kind of events as well. So you gather feedback in 2 days, packed feedback, and then you adjust your product from it. Which, by the way, if you three guys start collaborating at some point and Finance Magnets publishes it, I take credit for it. Okay. It was that's me.
Pleasure.
John, what do you have to add to what they were saying?
What I think here is data is key to service clients. So AI is nowadays one of the greatest tools for multiple reasons. It allows us from an LP perspective to be way more reactive to situations, and even at times be proactive. So when we can convey this information to our banks or to our LPs behind us, it's a smoother execution experience for all users, which in essence, we are improving the end user, being the retail customer, to the best of our abilities. AI is a great tool. I've always been very fan of it. However, I also say you gotta be very cautious with it, because sometimes some of that information, I mean, it's great to analyze tons of data, but don't forget that there still has to be that risk manager, that team analyzing the data and understanding what is the output you're getting before you convey that information, whether it's to a broker-dealer client of ours or even to our LPs. So there has to be a lot of filtration along the way so it can be utilized correctly. Because if we just go back to every LP and say, you know what, this tag is constantly, we see this behavior, and we're wrong on the assessment, right? And the markouts are not matching that statement we're making, then we're also misleading our own LPs, and then you start losing credibility. Yeah. That's one of the things you gotta be able to kind of understand before you display that info, even to our own customers. So there's a lot of greatness behind analyzing data, but you gotta be very careful what you do with it. I think that's the essence of innovation today.
I mean, definitely is one of the main topics in every single panel, because it can be, I mean, seriously, it's not just a buzzword. It's a tool that has been applied across every single department, I think, in every company, especially as the nature of the fintech industry being mostly digital, and how fast we always adjust and adapt and move things forward, etc. It's not the traditional finance that they're like very heavy in moving. Digital finance it's much faster in its pace. So I think that there is a great adoption, and as you were mentioning, Leanne, and I'm sure that also from the brokerage side, it's been applied on so many levels. But I wanted to ask you, is there any other expectations that any of you identify from the broker side, from the institutional side, right? That in terms of liquidity request or demand, or any new trends that you're seeing that are becoming more prominent?
From our side, I've seen recently, and I say this within 2025, clients are becoming very knowledgeable, which means they come to you with a very specific request on how you pricing them, what type of flow they're going to be sending out to you. They're already prepared to have that conversation. I remember years ago, it was like a very different discussion. So this is partly due to new tech being deployed out there, a lot of great liquidity hubs, etc., being or doing a great job actually for many participants. And then when that client brings you that particular approach, you know that that's a discussion that is going to lead in a certain direction, which is a lot more productive for all parties involved. So again, tech, AI helps tremendously to shift preferences and needs of clients.
Yeah, really agree. And I think we're really encouraging it at 26. Like we try to be proactive because in this world, there's so much data. And I think like we, on a daily basis, produce reports that have statistics around the pricing, which I think everyone's had pricing metrics for a number of years, and that's not necessarily anything new, but around, to reiterate, this execution and where the orders are being sent and what's happening with them and the effective spread. I mean, it's not just the price on screen, it's this effective spread. What are you actually paying and what is the actual cost of the fee?
And in terms of regulation evolution, because obviously, this is a regulated market, it keeps evolving. I mean, it keeps changing. There is different aspects to it on a constant basis. The other day when we were hosting the Marketing Leaders Forum, there was even a mention of like some sort of new regulation applied to influencers in the UAE, for example, which kind of already took place in some places in Europe last year. And it just like, it keeps adding layers and different things into the landscape of finance, fintech in general. How do you think it's going to evolve, especially related to liquidity? John?
Well, I think it's an evolving industry. It's always been definitely a lot of importance has been given to situations like this, influencers and all types of marketing campaigns being published out there. What I think the regulators are trying to do is to ensure that at the end of the day, it's a healthy industry. They're not against people doing business, but they just want to make sure that you have a true valuable product out there that is being priced fairly. And that's where the best practices come in, whereby whether you're a broker-dealer or broker or LP as per se, you may be in a position to facilitate the best service to your end users. So regulation, what it's trying to do is, as always, trying to make sure that it weeds out any bad actors from this entire industry. And it's not I'm one of the first to admit that regulation is probably one of the greatest things to have, provided that it's not over-regulated. So again, do regulators find that balance consistently? No, they don't. But at times, it's actually better to be over-regulated than not having enough frameworks in place to protect our audiences.
Without a doubt, regulation is something that it has to be here for 100%. It's the biggest challenge that we have because we need to be regulated and at the same time be competitive and be able to give the best service. Now,
and agile, right? Commercially agile as well.
Yeah, of course. I'm not personally familiar with the change of the influencers. I would assume it's more on the B2C side. I haven't heard of what took place. But I agree 100% because the regulation keeps coming at us. So if we're going to raise the bar, we need to keep up. How do you keep up? Inevitably, with the resources of the people. You bring people in, we have to recruit now. I mean, both our risk, our reporting, we invested in people in order to raise that bar up and be able to meet these requirements. But at the same time, there has to be a communication with the commercial side, with the business side. Because we need to be able to provide what we provide up until today. So this combination of things is very sensitive. So regulation, yes, is important, and at the same time, meeting the obligations that you have to do.
Maybe I can just add on from my perspective as well. With more regulation, in the past, for example, best execution analysis, it just used to be a compliance tick box that you just needed to get it done. But I think now it's now become more of a necessity in terms of it allows your liquidity providers as well to be transparent. And like Liam said, that what they do as well is they're able to show to clients how execution has happened to the final LPs. I think this is the transparency that I think regulation is able as well to enforce, and it has sort of bridged the gap in terms of both knowledge and from commercial point of view to be able to sort of lower trust of transaction costs because there is transparency as well.
That even goes to the first question. It's correlated. on our first question that we were saying, how come liquidity providers, we all agreed that the bar the standards are higher. All of these things contributed to this because the ones that couldn't keep up, obviously, they're out of that. So the ones remaining, they have to be aligned with all of this.
Liam, anything to add?
No, we face into regulation. We definitely don't sidestep it. We're like ASIC regulated and Japanese heritage, so there's no getting around it. I think digital assets and social media sort of sidesteps traditional regulation, and I think we're just seeing the traditional regulation, which to John's point is healthy for the industry and healthy for the end user, seeing that now be applied to these new products as it should. So, big supporter.
And there's actually a new development. I saw it early in the morning, didn't get a chance to read, but I think the US has passed a new legislation to regulate digital assets. That's going to likely change the landscape even farther within our industry because I remember 5 years ago, very few LPs were in a position to receive crypto deposits for margin purposes as collateral. Today, this starts to become the norm. And just 5 years ago, no one even knew what it was. I remember having discussions and it was like, I could see in people's faces, that reaction like, what are you talking about, right? So today we have a completely different landscape that is going to change even farther and it's going to be fairly quick.
Yes, and we don't even have to go back 5 years ago. I remember maybe 3 years ago, possibly 3 years ago, I remember a London summit, we were having a discussion on stage, and I'm not going to say who, but there was somebody that said that they were very skeptic about what was going to happen with the cryptocurrencies and the adoption for, serious purposes and actually doing business that, they weren't a big believer of that. And nowadays, it's like you're talking about stable coins and any cryptocurrency as if you're talking fiat, it's literally the same thing. So I think that the industry evolves really, really fast. And it's all of you, it's all the actors that are pushing literally step by step, growing faster and faster. I have one last question because we have 3 minutes left before questions. So my last question to all of you is, what is the single most undervalued factor that you think is taking place in the business of liquidity nowadays?
I'll go first. Are saying real-time dashboard. So knowing where you are, where you stand at any time. Because as you said, it's very volatile, it's very dynamic, it's very like one day is like this, the next day is something else. So knowing where you stand, risk-wise, exposure-wise, is very important. So I don't think any of us would be in business if we didn't have that in place.
And that's expected now, right? And I think your point on the redundancy and the resiliency, I think that can easily go undervalued for quite a while, and then you have an outage and it can, yeah, exactly, knock out other players, as you've said, or do some serious damage, and that's when you're happy to invest. So I think undervalued is investing in redundant technology, resilient technology, and even now with the global politics and the markets that are happening, needing to have liquidity across multiple centers. I think it's no longer just suitable to have liquidity in London, as a lot of people did traditionally, or maybe New York. We've seen a lot of market dislocations happen in the Asia Open, which traditionally has US-based dislocations happen during the Asia session. So firms need to be able to move dynamically in terms of technology, fail over automatically, dynamically adjust quote filters, and be able to make sure they're getting the true liquidity no matter what's happening.
Proactiveness as well, what you said before, like having stress tests in situations, because you have this geopolitical, we haven't even mentioned it, surprisingly, yes.
Actually, I have it in the questions, but because we're running out of time, I'll let you finish that and maybe somebody will bring it up.
I'll leave it to John because he wanted something to share.
I'll say on this topic, though, to achieve all these sort of redundancies and different locations where you're pricing out of, what people really undervalue is that partner needs to have true expertise in what they do. And the expertise is what will bring you to this horizon of different contingency plans. I remember not long ago, just something extremely basic. So we price primarily out of London, but I have a backup in New York. And then I have Tokyo as my third backup, all in real time. you come across sometimes that guys, I hear some people are pricing out of London, that they have a backup in London. Well, it doesn't really make any difference, right? Experience teaches you all these little details that you actually have a redundancy plan when it's needed at that moment that is crucial. So to me, the undervalue element is how much knowledge does that team really have in place? Because that would lead to a whole different setup, configuration-wise.
Reginald, do you resonate with what they were saying? Do you value any of the things that they were saying?
Okay, now I think just to conclude on my side will be just to add on. I think maybe most liquidity providers will have an edge now. Those who have sort of managed to build alternative liquidity sources. The biggest challenge I think is how can you substitute one feed to the other? You might find one LP is good in one aspect or asset class, but then they might not be good across all other symbols or asset classes. So what it does in terms of failovers, even if maybe you want to switch to one or to the other or aggregate, they then tend to be huge gaps in terms of pricing because one broker could be not so competitive in one asset class. So I believe the LPs that have the edge are the ones who are able to source liquidity with peers that they can compare in terms of the quality of the liquidity.
And I think a lot of firms make the mistake of solving that by having mass amounts of liquidity providers. And I think that's a mistake. I think you need 2, 3 maybe, and then you can verify those 3 and make sure that they're consistent. I think more is not always better.
I mean, more doesn't mean that you're capital efficient to begin with.
Good
so
point.
you put that constraint in the business, which is also something that you got to take into consideration.
Definitely.
Great. Thank you so much, all of you. We're going to open up the floor for questions. I think we'll have time for 1, maybe 2 questions. Anyone? Hands up, please. No? If not, I'll ask the last question. Great. Okay, so time for the macros. We do. Awesome. Okay, wait for a second. Then we'll get you a microphone.
Thank you, Squash. It's not really a question. It's about something that you said earlier. It's about the challenges that brokers face. And one of the challenges that we face, I would say, is high frequency trading and a lot of toxic flow. How should a broker create better risk management strategies in order to, have less exposure on this topic?
Thank you so much for that question. That's a very interesting question.
To me, that comes down to technology. You need a provider that has, as we're discussing, has the features that can react dynamically, whether it's AI or whether it's traditional methods where you can detect high flow rates and route that accordingly, because the price that the tight retail price you're showing is not appropriate for a high frequency trader. And if you hit it, it's not going to stay tight for you for very long. So I think technology is my answer.
Yeah, I would add, it's a combination of 2. It's the traditional way, which matters a lot. So the analysis of it and how we handle it usually is it comes we're talking about less than half of the day, we'll spot it most of the times, and then we'll come to you with feedback, and we will be able to show you both from the technology side and also from the analysis side. And then we will explain what our perspective is on the specific flow, and we will advise the broker how to take action on it. So we won't leave the broker on its own and simply take action. We'll just advise him how to handle it.
Okay. Maybe just to add from also a broker perspective, from our experiences, when we seek liquidity, we tend to, before we even go to onboarding or going live in trading, seek to have 2 feeds, where you have your premium feed, where maybe that's where most of your volume or your market making feed is on, and then have a defensive feed already set up with your liquidity provider that when these conversations come in terms of specific tags being sharp or toxic, then you can quickly just switch them to a more defensive feed that then doesn't affect your primary feed, which is huge extent we've seen it much more a better way of having relationship with LPs, because it creates a 2-way communication. The LP can tell you which tags are not okay, or you can do from your own pre-filtering that I want this feed to go to, or this trade to go to my defensive feed.
There's also 2 ways we do it there's 2 scenarios. When the broker, let's say the retail broker already has trading statement of the client, usually will request to see that bit from before. We accept it, so we will be able to give you feedback on that, whether you should take it or not. That's the one scenario. The second scenario is when you don't have the trading statement, obviously, which we would soft launch it, we'll soft take it, and then we'll analyze it and monitor it in a short time frame, and we will analyze and give you feedback again.
To summarize it, it's communication. It's about, realistically speaking, the flow will get picked up fairly quick. I mean, for most of us, we will be able to see that within no time. I always say, every client has a different trading behavior, geographically, etc. But communication with the LP is essence to your success. And again, I will resonate with your statement, Reggie. Typically, at least we set up clients on both feeds. So you choose who gets plugged in where. Now, obviously, the liquidity manager has to come to you consistently, hopefully on a daily basis, and share some of the research that has been carried out on a trading session to let you know if a specific tag gets picked up and why. So you can also go back to that end user and explain why there's a change in that liquidity source.
That's where the communication comes, because you tell your client, but he has to communicate with the end client, and that's where they need to understand.
But that's the beauty of today, right? These discussions are happening, they're very open, and it only makes a better industry for all of us.
And on that note, we're going to close this. My counter tells me we run out of time. So I'm going to thank you all for being so open and so insightful in the panel. Thank you for the question as well. And if anybody has any more questions, feel free to grab them as they come off stage before they run away. A big round of applause. Thanks so much.